China's May economic data was dismal, with slower than expected growth in industrial output and retail sales, a new high in youth unemployment rate, and further decline in real estate investment. This indicates that the economic recovery has lost momentum, prompting the People's Bank of China to lower key lending rates. According to data released by the National Bureau of Statistics of the Communist Party of China on Thursday, June 15, industrial value added in May grew by 3.5% year-on-year, lower than April's 5.6% and slightly below analysts' expectations of 3.6% in a Reuters survey. This data suggests that Chinese manufacturers are still facing challenges amid weak domestic and external demand. Meanwhile, total retail sales of consumer goods increased by 12.7% year-on-year. This key indicator of consumer confidence fell significantly below the predicted 13.6% growth and experienced a sharp slowdown from April's 18.4% growth. In May, the youth unemployment rate reached 20.8%, the highest level recorded since 2018, equivalent to 6 million unemployed young people. This indicates that the Beijing authorities are struggling to provide sufficient employment opportunities for the youth. The overall unemployment rate remains at 5.2%. According to a Reuters report, Link Zhiweizhang, chief economist at Pinpoint Asset Management, stated, "So far, all data points are sending a consistent signal: economic momentum is weakening." Various indicators such as manufacturing surveys, import-export trade, loan growth, and housing sales all show signs of weakness in the Chinese economy. Data from the National Bureau of Statistics of the Communist Party of China reveals that crude steel production in May declined both year-on-year and month-on-month, and daily coal production also decreased compared to April. In the first 5 months of 2023, housing construction starts decreased by 22.6%, while new home prices saw a slight increase compared to the previous month but remained in a downward trend compared to 2022. Real estate investment in May experienced the fastest decline since at least 2001, with a year-on-year drop of 21.5%. These weak figures contradict analysts' expectations of a more significant rebound, considering that many cities, including Shanghai, faced strict lockdown measures in May of the previous year. Currently, the Chinese economy is facing risks of deflation, increasing local government debt, record-high youth unemployment rates, and sluggish global demand. Bruce Pang, chief economist for Greater China at Cushman & Wakefield, stated, "Weak domestic demand and sluggish external demand may halt the momentum of economic recovery in the coming months." Pang emphasized the need for large-scale stimulus policies, but noted that it might take 2 to 3 years to support a sluggish economic recovery. On Thursday, the People's Bank of China, PBOC, lowered the one-year medium-term lending facility, MLF, interest rates by 10 basis points to 2.65%. This is the first relaxation of such rates in 10 months and paves the way for a potential reduction in the loan prime rate, LPR, next week. Following the rate cut, the Chinese yuan briefly declined 0.3% against the US dollar to 7.1807, marking a 6-month low. Chinese stocks rose, with the CSI 300 index increasing by 0.6%, and the Hang Seng index in Hong Kong climbing by 1.2%. Market participants anticipate further stimulus measures, including subsidy measures for the real estate sector, which was once a major driver of China's economic growth. In recent times, several major state-owned banks in China have lowered deposit rates to alleviate rate pressures and encourage savers to increase consumption. Julian Evans-Pritchard, director of China Economics at Capital Economics, stated that while the central bank's loose policy itself may not have a significant impact, it reveals growing concerns among officials about the state of China's economic recovery. He added that the second quarter has been weaker than expected, suggesting the need for further policy support to prevent the economy from slipping back into recession.